Let me give you a quick recap of what you need to know for the tax season 2020-2021. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as superb as I am, go grab a cup of coffee or a tea or vodka and let's roll. Today I'm going to give you a quick recap, everything you need to know for the tax season 2020-2021. First thing is tax day is Thursday, April 15, 2021. So in other words, you must file your 2020 tax returns by that date. The standard deduction for 2020 increased to $12,400 for single filers and $24,800 for married couples filing jointly. Income tax brackets increased in 2020 to account for inflation. Now, that's just scratching the surface. Now, I'm going to quickly, in this show, I'm going to break down to you the details so you can file with your taxes with confidence in 2021. So income brackets and rates for the 2020-2021 tax season. And you can see here on the screen, we have put this on the screen for you right now. So you can see that for the 2020 tax year, the tax rates are the same, but there are some slight changes to the brackets. Basically, the brackets have been adjusted by a few $100s from 2019 to account for inflation. So you can see on the left side, you have the 2020 marginal tax rate. So those go from 10% to 37%. And so you will pay the highest tax rate if your income is over $518,000 and $400. That's for single tax. You have the married filing jointly tax brackets in the middle, and then you have the head of household tax brackets, and then finally you have the married filing separately tax brackets. Overall, the numbers are pretty similar to last year, the 2019. The only difference is it's just, as I said earlier, you have a delta of a couple of $100. About the standard deduction, you can see also on the screen right now, you have the standard deduction is $12,200 for single, $24,400 for married filing jointly. If you are married filing separately, you still have the same standard deduction, $12,200, and head of household $18,350. Those are the numbers of 2019. For 2020, you have $2,400 for single, $24,800 for married filing jointly, $12,400 for married filing separately, and $18,650 for those who are head of household. So the thing here is that when you actually pay taxes, you have two options, right? You can either itemize your deductions or you can take the standard deduction. So if you itemize, you calculate your deductions one by one. Itemizing is more of a hassle, but honestly, it is worth it if your itemized deductions exceed the amount of the standard deduction. So you have to keep that in mind. If your deductions are above or higher than $12,400 and you are filing as a single taxpayer, it's better to itemize. All right. Now let's talk about the tax deductions and credits to consider for the tax season 2020-2021. One thing that we love here at the Sweetie Kiwi Show when it comes to taxes, or we have deductions and credits. Those two are kind of cool because they will reduce your tax liability, right? So let me just quickly distinguish between deductions and credits here. So tax deductions help lower how much of your income is subject to federal income taxes. So some deductions are only available if you choose to itemize your deductions, while others are still available even if you decide to take the standard deduction. And that's one. And then you have the tax credit. Tax credit lower your actual tax bill dollar for dollar. And there are two types of credits. You have the refundable ones, and the non-refundable one. So if a credit, let's say if a credit is greater than the amount you owe and it's a refundable credit, the difference is paid to you as a refund. Fantastic, right? It's just great. But if it is a non-refundable credit, your tax bill will still be reduced to zero, but you will not get a refund. That's just still great anyway. So let me just kind of give you some deductions and credits you might be able to claim on your 2020 tax return. So you have charitable deductions, medical deductions, business deductions, earned income tax credits, and child tax credits. So the charitable deduction, if you like to give like no one else, that's great. You can still deduct this in an effort to actually encourage more charitable giving during the pandemic. The CARES Act allows you to deduct up to 100% of your adjusted gross income, which is your total income minus other deductions you have already taken, in qualified charitable donations if you plan to itemize those deductions. Medical deduction. If you spent a lot of time in the hospital or found yourself with some hefty medical bills last year in 2020, you might be able to find at least some tax relief, and you can deduct any medical expenses above 7.5% of your adjusted gross income, which is actually your total income minus other deductions you have already taken. For business deductions, if you are self-employed, there are various deductions you can claim on your tax return, including travel expenses and the home office deduction that people love, especially if you use a part of your home to conduct business, right? But if you're one of the millions of workers who were sent home to work remotely because of the COVID-19 pandemic, you will not be able, and I repeat, you will not be able to claim the home office deduction, since this deduction is reserved for self-employed individuals only. And you also have the earned income tax credit. This is a refundable credit designed to help out low and middle income workers. And depending on your income, your filing status, and how many children you have, the credit could save you anywhere from a few hundred to a few $1,000s on your taxes. All right. So, and the limit here is you have to earn up to $56,844 during the 2020 tax year to be eligible. And the child tax credit, if you got kids, that's fantastic, because families can claim up to $2,000 per qualified child with this tax credit, and the income limits for the credit are $200,000 for single parents and $400,000 for married couples. And since this is a refundable credit, your family can receive up to $1,400 per child as a refund. Now, folks, the thing here is that there are plenty of other deductions and credits that might be up for grabs depending on your situation. So it's very important that if you don't want to miss out on any tax savings, you want to work with a tax advisor who can make sure you're not leaving any deductions or credits on the table. You can even use tax software such as TurboTax, Tax Act, H&R Block, Credit Karma, and so on and so forth to kind of find a way to zero in on those tax credits and deductions. And I also want to talk to you about the coronavirus and your taxes. It's very important. We're still in the midst of a pandemic, but if you thought you were done with the coronavirus now that it's 2021, you basically got it wrong, because unfortunately, the COVID-19 and the government's response to it has created a ripple effect that will be felt when you sit down to file your taxes for 2020. Here are certain things I want you to keep in mind. Stimulus checks. So as part of the coronavirus aid relief and economic security, the CARES Act $2 trillion relief package, the government sent up to $1,200 in the form of stimulus checks to millions of Americans shortly after the pandemic shut most of the country down. Now, the good news is that your stimulus check will not count as taxable income. It will not. Instead, it is being treated like a refundable tax credit for 2020. In other words, your stimulus checks is sort of like an advance on money you would have received anyway as part of your tax refund in 2021. All right? Next, you have the PPP, the Paycheck Protection Program loans. So the CARES Act also tried to help struggling small business owners stay afloat by offering them a Paycheck Protection Program loans. So as long as these loans were used on certain business expenses, I'm talking about payroll, rent, or interest or on mortgage payments, and utilities, to name a few. These loans were designed to be forgiven. So, small business owners, please listen. The IRS says that any expenses that you paid with money from those PPP loans cannot, and I repeat, cannot be deducted from your taxable income. In addition, you'll have to get your loans forgiveness application approved by the SBA before you're off the hook for the amount you borrowed. All right. So the thing here is that you have to actually reach out to the SBA. You also have unemployment benefits. So many Americans found themselves out of work, at least temporarily, after the COVID-19 pandemic shut down a large part of the economy and turned to unemployment insurance for help. So those who received unemployment benefits will need to pay income taxes on that money. They will need to pay it. So if you chose not to have taxes withheld from your benefits when you signed up, then you'll either have to pay quarterly estimated taxes or set aside enough money from your unemployment benefits to pay your taxes come tax day. Let's also talk about the educational expenses. So 529 plans and ESAs. So any money you take out of a 529 plan or educational savings account must be used for qualified educational expenses in order to be tax-free. That kind of makes sense, right, folks, if you think about it. But a lot of schools went remote or canceled classes this year last year, 2020, which means that your college might have refunded some or all of your 529 or ESA money. If that's the case, you have 60 days to put the money back into the account or use it to cover other educational expenses, because if you don't, you might have to pay income taxes and a withdrawal penalty. So there are a couple of ways you can use 529 plans in 2020 without having to pay taxes. First, you can now use 529 plans to pay for the cost of certain apprenticeship programs, including fees, books, and supplies. And second, you can also use the money from a 529 plan to pay off up to $10,000 in student loan debt. That's $10,000 total, not annually, without having to pay any penalties or taxes. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. We are I'm just giving you a quick recap of the tax season 2020, 2021. Let's now talk about retirement plans. So the 401ks, IRAs, and more. So there were a lot of changes to retirement plans in 2020, and some of those changes could impact your tax bill in 2021. Now let's just quickly go through some of those major changes. So we have the CARES Act. All right, so the Coronavirus Aid, Relief, and Economic Security Act. This act allows folks under age 59 and a half to take up to $100,000 out of the 401ks and IRAs up until the end of 2020 without having to pay an early withdrawal penalty. But first, withdrawing money out of your retirement account before retirement is a terrible idea, penalty or not, right? So this is something you have to think about. It was not meant for early withdrawal. That money has to sit there to cover your retirement. Second, the money you take out of your account, the money you take out of a tax-deferred retirement account, like a traditional 401k or IRA, will be taxed as ordinary income. So get ready to pay taxes on any withdrawals you make. If you own a traditional IRA, you have to take money out of your account once you reach a certain age. So those withdrawals are called the RMDs, the required minimum distributions. So the good news is that the Secure Act pushed back the age for RMDs from traditional IRAs from 70 and a half to 72. So if your 70th birthday was July 1st, 2019 or later, you're still fine. On top of that, the CARES Act allows seniors to skip RMDs altogether in 2020 without penalty. That's pretty cool. That's huge, folks. That's fantastic, because this could lead to significant tax savings for retirees with those accounts, since the money that's taken out of a traditional IRA counts as taxable income. Another major development you need to be aware of for the 2020-2021 tax season is that the Secure Act also allows owners of traditional IRAs to keep putting money in their accounts past age 70 and a half starting in 2020. So since the money you put into a traditional IRA is tax deductible, you could lower how much of your income is taxed this year. And this is kind of cool too. Now, one thing you have to remember though, that you will have to pay taxes on that money whenever you take it out anyway, right? So that's kind of important to remember. And one last thing, if you did take some money out of a 401k or a traditional IRA and you happen to be facing a huge tax bill, there's no time to actually panic. You don't have to panic now because you have 3 years to put those funds back and get a refund on any taxes you paid on that money. And more important, it will help you get your retirement savings back on track. So it's probably a good idea to reach out to an investment professional who can walk you through the process. You can even reach out to a tax attorney, you can reach out to a financial advisor, you can reach out to a CPA, to a certified public accountant, or any other investment expert who can walk you through the process when it comes to retirement, but also when it comes to taxes. So you want to have an expert guide you, help you navigate the fiscal process, but also the retirement process. All right, folks, this is it. I really appreciate your attention today. I just, today I just want to give you a quick recap you need to know for the tax season 2020-2021. I spoke to you about the income brackets and rates for the 2021 tax season, the higher standard deductions, the tax deductions and credits to consider for the tax season 2020-2021, the coronavirus and your taxes, how the COVID-19 pandemic has affected some of the tax situations we're currently in terms of stimulus checks, the Paycheck Protection Program loans, the unemployment benefits, the educational expenses, the 529 plans and ESAs, and also the retirement plans, the 401ks, the IRAs, and more. Thank you so much. I'll see you next time. But until then, remember, stay marvelous.